Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Once again, it's my great pleasure to welcome you to another Subscriber Request Tuesday. For this week's installment, I'm going to actually be covering 4 dividend growth stocks that I consider to be very attractively valued, offer a margin of safety and high current yield. But best of all of these companies have good long streaks of increasing their dividend. So if you're looking for dividend growth and you're looking for good value and you're looking for safety and quality, I think you're going to really like this video. Now, because I'm going to be covering 4 stocks, I am going to point out that I'm just going to hit the high spots. I'm going to look at earnings and cash flows and some other metrics very quickly, but I'm not going to get into an extensive look at each of these companies. What I really want the subscriber to see here is what these companies look like, what their operating histories have been like, and what they look like going in the future. So I'm going to start with a portfolio review utilizing the new and improved version of FastGraphs, which, by the way, is an update we're going to be launching now on Saturday, December 4th. So those of you who log in on Sunday will start seeing the new version. It's going to be launched in beta. I'll be putting out a letter to all subscribers, and I'll be making some announcements as well as doing a tutorial video later this week on how to navigate the basic FastGraphs, one of many tutorial videos that I plan on doing for you. But anyway, let's start with a portfolio review here. The 4 companies I'm going to cover for dividend growth and dividend income are Leggett Platt, Omnicom, Philip Morris, and Enterprise Products Partners. Now, all of these are companies that were requested as a result of doing other videos. For example, I recently covered Enbridge, and I was asked to compare it to Enterprise, so that's why you're looking at it. I was also asked to compare it to Altria. I had another subscriber ask me about Omnicom, and then Leggett Platt was another one. And these are all investment-grade companies, BBB to BBB plus rated. Their dividend yields range from a low of 4%, we'll call it, on Leggett Platt, all the way up to 8.19% through yesterday's close on Enterprise Products Partners. Now, to give you some color on these companies, Omnicom has had a dividend growth streak of 12 consecutive years, Enterprise Products 24 consecutive years, and then we have 2 aristocrats, Leggett Platt at 50 consecutive years of raising their dividend, and Philip Morris at 52 years. I call it Philip Morris. It's Altria Group. MO is the old symbol for Philip Morris, which the company spun off Philip Morris International, which is now known as Philip Morris. But anyway, these are the 4 companies I'm looking at. Now, all of them are attractively valued relative to PE ratios and earnings yields. Leggett Platt has a PE ratio of 15, slightly higher than I like, but the stock is down today. This is based on yesterday's close, so I think we're probably hitting the 6.6 or 7% earnings yield. The other stocks, Omnicom at over 9% earnings yield, Altria at over 10.5%, and Enterprise Partners at just under 10% at 9.94%. So all these companies look very, very attractive. I'm going to go in order of the shortest dividend streaks to the longest. So I'm going to start with Omnicom here and look at it from a standpoint of what the company's business has looked like and valuation. Now, I'm going to take price off of the graph because I want to make a couple of points like I like to do. The white line on this graph is the dividend line. This company has increased its dividend, as I mentioned, for 12 consecutive years. When I look at performance, they did not increase their dividend during the Great Recession of 07 and 08, but they did maintain it. Okay, so I still consider this to be an exemplary record. And going back over the last 20 years, they've increased their dividend every year except one. But then they've had 12 consecutive years of raising the dividend since then, and they've raised the dividend at about somewhere between 10.5% and 11%. Average growth rate has been 11. Compound average has been 10.54%. You can see they generated significantly more income than the S&P. But again, these are income stocks. The capital appreciation was not that good compared to the S&P. But I do want to make a point and a clarification on that. Okay, when I put closing stock prices on the graph, and this is so important, and I get comments every time I do a video, people just seem to overlook this or ignore it or not talk about it. If I'm looking at their long-term historical performance here, as I said, it's not that great. okay? But it's not horrible, but it's been about 6%. And I'm going to get closer. I'm not going to use exactly the same data. But what I'm looking at is about a 3.8% total annualized rate of return. But that's because, and I want to really emphasize this, because the stock was significantly overvalued at that point in time. Okay, if I shorten this time frame down to a time frame when the stock was undervalued, like it was, say, in January of 2009, and again, I'm just picking dates here, I'm not being real precise. Now, all of a sudden, I've got double-digit rates of return of over 10%. The big difference is valuation. This was a 5% grower that started undervalued, is undervalued today, but yet because of the dividend and the capital appreciation, I do have the ability to generate a double-digit rate of return. The stock went from $25.89 to $67.47, which was yesterday's closing price. But there were also times, as you can see, where the price got very high and then times where the price got low. This gives us a good opportunity to buy Omnicom. I think it has a great margin of safety here, meaning that I believe the stock year-end stock price ought to be about $93 a share. You can buy, as I said, all you want at $67, but that's a month away. If I go out to year-end next year, I think it's a $97 stock. The average rate of return would be almost 44%. I get people making comments that these aren't good returns. This is if the stock trades at a 15 PE ratio and if it ends up earning $6.47, which is a consensus of leading analysts, and this is an earnings number that is actually increased. Okay, that's an incredible rate of return, but where that comes from is growth of only about 3.5% and PE ratio expansion going from a PE of 11 to a PE of 15. That's what I call natural leverage. That's where you're really going to make your money here. And so, when you look at a stock like this, you got to remember, you're not buying the past in the first place. You're only buying the future. Now, if I go out a little further, my return's not going to be quite as high, but it's still going to be almost 26% a year, and that includes dividends. And again, that's because I'm going to get PE ratio expansion. Now, if I look at the chart historically, the blue line and the orange line on this graph over this time frame, going back to coming out of the recession, has been a solid 15 times earnings. And there's been many times, as you can see, it's been over 15 times earnings. And the point I'm making is it isn't a big stretch for me to say that I would think this company could easily trade at 15 times earnings over the next couple of years. And the company is expected to give pretty decent growth. Earnings this year are going to grow about 23%, about 3.7% next year, followed by 6%. The long-term growth rate for the company is expected to be almost over 13%, however, and there really is a great long-term opportunity. Now, one thing I like to do is check other estimates here. I'll do that very quickly by going into Yahoo Finance, and they expect the next 5-year earnings growth to be about 9.5%. So I feel very comfortable somewhere between 9, we'll call it, and 13% will be the average long-term growth rate. I think this is an incredible opportunity, offers a 4% dividend yield. And when I measured performance earlier, I want you to remember that I was measuring the performance of this company when it's undervalued and comparing it to a stock market, an S&P 500 that is significantly overvalued, that is currently trading at a PE more than twice as high as Omnicom. Anyway, there's Omnicom, the first of the companies that I was going to cover here. Now, next, in order of earnings growth streaks, I'm going to go into enterprise products. Now, I was asked, this is an MLP, and I did talk about this quite a bit when I covered Enbridge. I'm going to put the link to the Enbridge article in the video here. You can go ahead and check the Enbridge article. This one does come with a K1. When you're looking at a stock like this, I think it makes sense to look at it from a standpoint of operating cash flow. Because if you recall, when I went into fund graphs for you with the Enbridge video, one of the things about these large pipeline companies are that they have a tendency to increase their stock holdings quite a bit. So what I'm going to do here is go into basic and diluted shares outstanding and evaluate that from a standpoint of these companies are very capital intensive and they need to raise capital. So you can see the company's been issuing new shares regularly. They did buy back some shares coming out of the Great Recession when their valuation was real low. I like that. but otherwise they're constantly issuing shares. So the moral of the story is, when you're looking at a company like this, these MLPs, you want to look at it from a standpoint of cash flow. And what you really want to see is the cash flow covering the dividend. And Enterprise Products cash flow definitely is covering their dividend. And the company has a lot of potential. If I'm valuing this stock based on cash flows, once again, I see a very strong rate of return with an 8.3% current dividend yield going out. I don't see a lot of growth going forward, but again, because of potential PE ratio expansion and an 8% dividend yield as my base, I see the opportunity to see a very high double-digit rate of return on the stock. Its long-term performance from a standpoint of dividend income has been absolutely incredible. As I pointed out, they've raised the dividend for 24 consecutive years. The last 20 plus here that I'm showing has been over 6% growth of the dividend on average. It did kind of slow down during COVID and in recent times, but it's anticipated to grow again. And you can see it's thrown off an enormous amount of income relative to the S&P, and frankly performed just about as well as the S&P. Capital appreciation was slightly less, but you add the dividend and growth up, and this company has dramatically outperformed the S&P 500 since December of 2000. And again, income has a lot to do with that, and you can see currently the stock is trading at a very low valuation relative to historical norms, and I like it very much as a dividend income stock, and I am long both Omnicom and Enterprise, I might point out. The next stock on the list here would be Leggett Platt. Leggett Platt is a dividend aristocrat. The company's raised their dividend for 50 consecutive years. It's not necessarily my favorite from a standpoint of performance, but if you look at this graph, you can see there's cyclicality in earnings. There was a period during the Great Recession that they actually paid out more than 100% of their earnings. Okay, that's a kind of a red flag. You can see in 07 and 08 they paid out over 100% of their earnings, but it is a dividend aristocrat, and I think the real point is they did raise their dividend. Now, they didn't raise it a lot. They only raised it by 2 cents in 09 from 08, and then by 6 cents in 2010. But then subsequent to that, as you look, they were, given nice 3 and 4% dividend increases, but we have about a 6.7% average, 6.54% compound average rate of dividend growth. The stock was overvalued just a matter of a few months ago. It's become reasonably valued today. And I think it looks attractive to me at this level. It does offer a modest margin of safety, and it's expected to grow at about, 10% next year, followed by 10% the following year. That gives me the potential to make double-digit rates of return if the stock traded at its growth rate over those years. And that's, possible. If I use the normal multiple, which is even higher, the stock could give me a higher rate of return. And note that the stock does have a penchant to trade at a very high multiple, and I think that's attributable to the company's dividend status. So, it's a triple B rated company. It does offer a 4.08% dividend yield. The earnings yield is about 6.5%, but again, the stock, the last I looked, was down today. It's down about 2%, so that's pushing the dividend up to 4.17%. So, it's got a nice margin of safety given the fact that the market is off a little bit. Okay, and then moving on, last but not least, the dividend star here would be Altria, symbol MO, which was the old Philip Morris. This company has increased its dividend for 52 consecutive years, and this is a classic picture of the importance of valuation. Long-term performance of this stock, the dividend yield has been absolutely enormous. $10,000 invested in December of 2000 and held through yesterday's close would have thrown off more than 3.5 times your original investment in income alone. The dividend has grown at an average rate of over 10% compound or average. It's produced significantly more capital appreciation than the market as well, and has outperformed the market in virtually every way you can look at it. And I want to remind you that the stock is currently undervalued with the market being overvalued. It's throwing off an 8.28% dividend yield currently. There is an enormous margin of safety here, I believe, in the stock. I'm looking at current years. If this stock trades at a normal 15 PE ratio, you could see a 70%, 69+% annualized rate of return by the end of next year, we'll call it 13 months, and over 38% by the end of 2023. Long-term growth expected to be about 5.5%. That would still give you 20% plus annualized rates of return with an 8.25% dividend yield. So here you have it. These are subscriber requests. I want to emphasize that and be clear about that. These are companies that you have asked me to cover, okay? I do have a position in Philip Morris. I do not have, Altria. I just can't get away from calling it Philip Morris because I've called it that for so long and have followed it for so long. You might not like their products, but you got to love their business results and certainly their shareholder returns that they've generated on behalf of shareholders. I also own Omnicom and Enterprise Product Partners. I do not own Leggett Platt, but I do consider it a stock that is at a rare opportunity to buy it at an attractive valuation today, considering, it has such a long streak. Again, 50 consecutive years of raising their dividend. That's pretty impressive. If you like this video, please give me a like. Please ring the bell if you want to get announcements of future videos. I do these subscriber requests every Tuesday, and sometimes I like to just go through them quickly like I did today because I want you to see the business behind the stock. And I also want you to see the relationship of earnings and market price when you're looking at stocks like this. By the way, we will be launching our new version that I've used in this video on December 5th, which is this coming Saturday. We're very, very excited about that. I will be doing some tutorial videos, as I previously stated, and then many more to come. We will be launching in beta. We think the product is ready for launch, but we do expect there to be some minor issues, and we would look to you guys that are subscribers to point them out and help us review. And then, of course, we'll be working on this. The original product launch will be pretty close to what you're used to having right now. But with this new version and this new software platform, we're going to be able to really upgrade this product very quickly and efficiently going forward. So I want you also to look forward to a lot of upgrades and potential upgrades coming once we get past this initial launch. I'm really excited about it. It's been a long time coming, but we appreciate everybody's patience, and we'll be talking to you again real soon. Thanks for watching.